Hi everyone, weekly stock market update, and a critical time for the market. Is it going to now turn tail and go upwards, or is it going to continue lower? We've had quite a lot of earnings, which I'm going to go through and show you what I think is actually going to happen. So valuations, which is where we always start. Yes, they look expensive, but valuations are not the only thing that drives stock prices, which comes as a shock to people. You'd think they didn't live in the real world and realize that revenue growth, for instance, and dividend yields and cash flow are all important drivers of stock prices, including, of course, momentum, which seems to be the sort of ugly cousin you don't ever talk about of stock price movements. Energy is undervalued. You're paying $11 for every future dollar of ExxonMobil, whereas you're paying $29 for Microsoft, which just goes to show, given that Microsoft generally performs better than ExxonMobil, that valuation are not the only factors. All things being equal, if we pick healthcare, energy, financials, or telecom services, we'd be over the moon if they meet our other criteria. If they do, that's great. If they don't, then we won't have them anyway. These are the things we're going to talk about in this week's stock market update. Everything from the S&P, the NASDAQ, Microsoft, Apple, Nvidia, Meta, Alphabet, and so on. Remember, very important that I don't just give you the information, but I also teach you in these: value, growth, income. Stocks have to tick all of those. I created a proprietary algorithm which is based on the research work of Daniel Kahneman, Richard Thaler, and Eugene Fama, who went on to win the Nobel Prize in Economics, to calculate which companies do the best. Value tends to be more heavily weighted than growth, more heavily weighted than dividend yields. Croaky comes from Goldman Sachs Wealth Management, as you may well know. Momentum from the hedge fund industry, Sortino and Alpha. Basically, with Sortino and Alpha, what we're looking for are companies which are consistently high performers, rarely dip too much, and outperform the market. In other words, hopefully their share prices move as close as possible to something like that. That statistically is what those two numbers in combination do. We then look at 10,000 companies to pick the best ones that should be in my portfolio for the subsequent 12 months. Now, how has the past week done more broadly for the markets? Well, those overvalued tech companies are the ones doing well, which just goes to show, and we'll come to Qualcomm in a moment, and NXP. Oh, we'll come to PayPal as well. And the undervalued energy ones, not so well. Don't read too much into just 1 week's performance, but what I would say to you is that it just goes to show that value isn't the only factor to consider, and as I said, growth, income, momentum are important. Amazon is not exactly a fly-by-night company, neither is Alphabet, yet wouldn't you like your pension in a week to be up 6% or more? Exchange-traded funds, have a look at alpeshpatel.com/links for more videos on this. I will do a deeper dive into China and Chinese companies. I've recently looked at JD.com, which isn't the same as JD Sports, but there are slim pickings, I'm afraid, even though the exchange-traded funds, which are index trackers, are doing well. Why might that be the case? It's often because they're driven purely by momentum and not enough of the other factors, which doesn't give me sufficient safety. And I'd rather, a bit like a cricketer leaving a good ball out of the way, I'd rather not play and swing for every shot. Too risky. Year to date, very unusual what's going on year to date. The S&P 500 is up 6%. The UK market's up almost the same. That rarely happens. Almost never happens, which suggests you might want to go long the S&P and short the FTSE if you're into trading. The NASDAQ underperforming the UK is unusual as well, and the Dow's down there. That won't last for long. What you will get is more of a reversion. I'll just show you like this. Okay, where over the past 1 year, the last 12 months, the NASDAQ's up 32%. Your pension should be as well. S&P 500 is up 21%, the Dow's up 12%. I'm sure most of you would take a 32% rise in your pension, or even 21%, or even 12%. Instead, if you're in the UK, you're probably stuck with some 8% over 12 months. Let's just go across those two charts that I missed a moment ago. Right? So, energy is the sector driving market performance. Now, I don't tend to gamble at the start of the year which of these horses and sectors is going to do the best. Is it going to be communications? Is it going to be utilities? Is it going to be financials? What I look at is bottom up. I look at the companies, and then I don't care which sector they're in, as long as the company is doing well. You might say, well, surely companies are correlated to sectors, and therefore, if the sector's going up, the company should do well as well. Well, that's one way of looking at things. I won't go into the statistical reasons why it's not a particularly good way of looking at things. Far better to pick at the company and the results there. So now let's look at growth, value, momentum. All of these factors are important for how stocks perform. All of these factors are important. So how do you know which one without gambling on them? Well, you make sure that when you're picking stocks, you pick the ones which are not just growth, and not just growth and value, and not just growth, value, and momentum, and not just growth, value, momentum, income, but are the small subset out of which tick all of those boxes. That way you necessarily have those winners. Now, how do you do that? Well, you need a large data set, because you're picking the best of the best of the best. You're filtering. You don't want to start with... Think of it this way. If you only had 5 stocks to filter from, you're not going to get a good one, are you? If you had 10,000, you are. This one I've already discussed. Let's just look. This is just for information, nothing else. Over the past month, the S&P 500 stocks which have done the best, okay, the ones which have done the worst. Really surprised at how poorly Intel has done, given it's in an interesting space. We'll keep an eye out for it. And healthcare, given how many healthcare stocks are cheap, and Intel, given how popular chip stocks are. We'll keep an eye out to see if there's now an opportunity to actually have substantial gains from those. FTSE 350, 1 month, you've got these. Again, just for information rather than anything else. And the worst performers over the past month are these. Remember, JD.com, the Chinese company I spoke about, is not JD Sports. Okay, they're two different things. So how, most importantly, is the FTSE 100? Now, this is critically important. The S&P 500. This is critically important because we've had this dip, and the issue is what is likely to happen. Well, the most important thing of all is that the monthly MACD is moving higher. At worst, it's going to do this. As long as it doesn't fall below its own moving average, we're safe. If it falls below its own moving average, I would not want to be in. I'd exit. As long as it doesn't fall below, then I know we're going to get a headwind. It happens. Some days are rainy, but we should get a recovery. So this pattern you see here often happens. How do you know it's that, i.e. up, down, up again, rather than up and then down? Okay, so how do you know it's one you want to weather the storm, maybe take some profits, or one where you just want to be in cash? The clue is this, the monthly MACD. If it falls below, you want to be out. If it doesn't, you can still hold it. Well, what about that ride? What if you don't want that? Well, you can be risk averse and go, as I have done, into more cash. So I've got 30% cash roughly, I think, at the moment, because I've sold my Microsoft and my Meta and half my Apple, amongst others. How is the FTSE 100 doing? Well, it's on a bit of a rip at the moment. The only problem is it's done that many times before and hasn't followed through. It sort of runs out and gets exhausted. So I'm afraid I don't have much hope that it's going to be different this time. The NASDAQ 100, these are the monthlies. Well, it's doing sideways. Now, I've said this time and again, it can do this on an upward trend. Look at that period here, where it has prolonged periods of sideward moves. And what you want to do is see, look at the duration before it goes from peak to trough back to peak, and look at the depth of those moves. That drawdown danger, depth and duration, DDDDD, drawdown danger, depth and duration, is a pretty good telling sign whether or not your expectations are being managed, and that's well within my expectations of what it periodically does in an upward move. Indeed, look at what it did here, where duration was that and drawdown depth was this. Okay, so that's where we are with the NASDAQ 100. Apple, as you know, I sold half. Why? Because the monthly moving average is below its MACD is below its moving average, so I sold half. Why didn't I sell all? Well, it's one of my quality 5, so I didn't want to sell all, but that's where we are with Apple. Okay, Alphabet is for Great Investments Program only. Microsoft. Amazing, fascinating things with this in part 2.